I'm Chad Sander, Director of Investments with Payne Wealth Partners. I'd like to give you a little bit of a recap of 2013 in the investment markets, and then also talk briefly about what we see going forward in 2014. It turned out to be a fantastic year in the U.S. in 2013. The S&P 500 index was up about 32.4% last year, which was a phenomenal move and unexpected by most market observers. Even though we saw stock prices increase dramatically last year, we do think that the market at this point in time is fairly valued. Looking at the price to earnings multiple, which is a measure of valuation, currently the market's trading at a little over 15 times earnings, and the long-term historical average is right in line with that. So even though stock prices made a major move last year, we don't think at this point in time the market is overvalued. Instead, we'd say it's fairly valued. With that said, we would not be surprised at all, given the advance we saw in 2013, to see the market take a pause at some point this year, or even a pullback from its current levels. Bond prices in 2013 were much more challenged. This is due to the threat of rising interest rates, and also the Federal Reserve starting to reduce the stimulus that's running through our financial system. In December of last year, the Federal Reserve announced that they were reducing or cutting back their bond buying program by $10 billion per month, from $85 billion to $75 billion. This initial step in reducing monetary stimulus can be attributed to a variety of things. One is a falling unemployment rate, two, a very resilient economy, and third, an upcoming leadership change at the Federal Reserve. We think all of those things combined convinced the Federal Open Market Committee that now was an appropriate time to begin reducing stimulus in our financial system. Although the Federal Reserve has announced that they're cutting back on buying long-term bonds, they've made it very clear that they'll keep short-term interest rates, as measured by the Fed funds rate, near zero, roughly 0 to 0.25% on an annualized basis, until they see more resilient economic growth and the unemployment rate begins to approach 6%. So what are we doing in today's market, especially with our bond portfolios? We continue to allocate a lower percentage of portfolios into the fixed income market. And secondly, the majority of the bond holdings we have are shorter term in nature to provide flexibility at the point in time interest rates begin to rise. Also, we've allocated money to mutual fund managers that have the ability to shop the bond market worldwide looking for the best values, and also, when appropriate, sell bonds short to capitalize on the opportunity of falling prices. As we enter 2014, I'd like to share my thoughts with you on those things in the economy or the markets that are influencing how we think about investing. First is that we think that the U.S. economy and the global economy will continue to improve this year. We expect the U.S. housing market to continue to recover, and that's being aided by still relatively low mortgage interest rates and a high affordability index currently. Growth we've seen in household wealth over the past 5 years has increased consumer confidence and also increased consumer spending. We think that trend continues going forward. Even though the Federal Reserve has started to reduce stimulus, we think that they'll proceed in a very slow and measured manner. And we think that at this point in time they're more concerned about deflation still than inflation. Thus, monetary policy, we believe, will continue to be supportive of risk investments. We also believe it's very important to remain globally diversified with your portfolios. A weak spot in the market in 2013 came from emerging markets, those countries in Latin America, Asia, and Eastern Europe. Last year, the MSCI Emerging Market Index that tracks the returns collectively of those markets was down 4%. That area has been flat to slightly negative over the last 3 years. At this point in time, we are attracted to the low valuations of those stock markets. Collectively, emerging market equities are trading at roughly 10 times earnings. We think this is a very attractive valuation, especially relative to the U.S. And going forward in coming years, we expect strong economic growth from emerging countries. We expect a pickup in labor growth, productivity, and we think that those things combined will help generate better returns in future years. We appreciate the confidence and trust you've placed in us, and we look forward to continuing to serve your investment needs in the year ahead.